When you analyze a stock for purchase, what's your top 5 quantitative metrics that you look at?
We're looking at quantitative and qualitative. We aren't looking at the aspects of a stock. We're looking at the aspects of a business. It's very important to have that mindset that we are buying businesses, whether we're buying 100 shares of something or whether we're buying the entire company. We always think of them as businesses.
Hello everyone, welcome to Just Invest Today. And today we're talking about the top 5 quantitative measures Warren Buffett uses. And you just saw in that clip. He doesn't even really look at those 5 metrics. He doesn't have 5 metrics in his mind to look at when he's evaluating a business. He says that every business is different. Businesses have different metrics to look at. So he doesn't look at some specific price to sales, PE ratios. Those things are all good. That's just a small part of it you can look at, but you have to understand the big picture. And that's when you have to view businesses as businesses and not stocks. And you just saw it in that video. So when you think about this, I think about so many different aspects. Like when you think about Amazon, if you just use a screen to get all the quantitative metrics, like, oh, you want a business with a high return on equity, you want a business with this much revenue growth, 20% revenue growth, you want a business with at least 50% earnings growth, you want a business that's getting their book value up 10-15% yearly. Whatever those metrics you're trying to screen, you're gonna miss a business like Amazon because you're just trying to focus on the screen. You're not actually looking at different businesses and just imagining where they can go in the future, how big they can get, what are they changing and what are they doing. You probably would have missed a business like Tesla if you just looked at all their earning growth and all the book value growth, and if it's not earning money, you would probably miss the business like that as well. So this is helping me, and this is gonna help you find different businesses, because I've made that mistake so many times, just looking at the perfect screened business and just thinking about those businesses. If you look at a business like Amazon that was making all their money, but it wasn't showing on the balance sheet because they kept reinvesting all that money into growth and it was losing money, we would have missed a business like that. So that's why someone like Morris Probri says he doesn't use screens.
We don't know how to buy stocks just by looking at financial figures and making judgments based on ratios. We may be influenced a little by some of that data, but we need to know more about how the company actually functions. And anything a computer could be function to do in terms of screening, I know I never do it. Do you use a computer to screen anything?
No, I don't know how to.
No.
That's when you look at someone like Warren Buffett, like Charlie Munger. They say they don't use screens because if you use specific screens, you're gonna miss different types of businesses because there's different metrics that you have to look at for different types of business. And that's where we accumulate a lot of different knowledge about a lot of different businesses, and we look at different metrics. Like if you're looking at a bank, you might look at the book value and the book value growth. And if you're looking at maybe an e-commerce business, you're probably going to look at how many new visitors are they getting, or how many people are getting into their services, like just different metrics for different businesses. And that's the key factors, because there's going to be like 2-3 metrics that's really going to drive the business home and give you a good perspective on how this business is doing. So understand, you can look at screens, but don't just focus on screens. Focus on the bigger picture of just viewing business in general. Warren Buffett doesn't use a precise PE ratio or price to sales ratio to make an investment. He understands the business and has an idea of what the business will become in 5 to 10 years with a certain confidence in his judgment. And then he finds a big difference between price and value. And if the value is way higher than the price on the market, he buys heavily, knowing that he's going to be right if he holds it long term. So we got to find businesses with amazing cultures, with long-term vision, managers that are looking at a different destination than just a short term, management that has the view of getting this company bigger. That's probably the biggest mistake that everyone makes right now when we're thinking about value investors, and this is something I have to get better at, is just viewing the numbers and not looking at the business and seeing the future potential of the business. And that's something Bill Miller says that's a lot of mistake of value investors. Even though a business is losing money, they don't think it's a value investment because it's not making money right now, but they can't see the bigger picture of what that business is becoming, what that business can do. So there you go, guys. Thanks for watching this video. Can you please like it, share it, subscribe to my channel? It's gonna help me a lot. I'm on the road to 1,000 subscribers. So that's it for the video, guys. Thank you. Peace.